talk to me a little bit about, why the growth in impact investing has been slower than one would expect, just given, the tailwinds we've been talking about, the interest from people who want to work for companies that are doing the right thing, the needs, right? So we've seen the IPCC reports, the several reports that have been out over the last 6 to 8 months. There are absolutely tailwinds here. So whether or not you care about the planet or care about people, there's an investment opportunity here. Can you talk to me a little bit about what's slowing things down, or why the adoption hasn't been as wide as maybe you and I would expect?
So the growth in ESG has been a tripling over a period of 7 or 8 years to about 40 trillion. So, it's no mean growth rate. But the climate effort has concentrated until very recently on governments talking to one another. And now what we're beginning to see, which is accelerating the move, we're beginning to see investors who become aware of the changed preferences of consumers and talent, putting pressure on companies to change their behavior. The reason this hasn't happened earlier is lack of transparency on impact. Already we're seeing greenwashing, right? And people pushing in two directions. Some saying this greenwashing shows that this area will never take off. It's impossible to measure impacts, and people are just making claims, and it's all a load of rubbish. Let's go back to just making money. And then there's a second group in which I would count both of us, which is saying, oh no, with big data and computing, we can measure the impacts of companies more accurately than we measure risk, almost as accurately as we measure profits. And what we need is a standardized set of impact principles so that we can compare the performance, the impact performance of companies in a similar way to comparing their profits. And then the financial markets begin to drive this. The flows of capital lead investment organizations. We've seen yourselves and many of your colleagues in the investment business launch products that seek to achieve impact. It could be in private markets, it can be in public markets, it could be in the bond market or the equity markets. We're seeing that happen everywhere. We're beginning to get products now that measure the impact created. And the transparency that is about to come is going to be the foundation for a new impact economy. And I make a comparison with what happened in the early 30s. After the crash of 29, the Wall Street crash, investors realized they'd been investing in companies without real transparency on the profits these companies make. Every company then picked its own accounting principles, and there were no auditors. In fact, companies could put money in hidden reserves without telling shareholders how much had gone into them. It seems unbelievable today, right? And when the idea of GAAP accounting, generally accepted accounting principles, and the use of auditors was stable, there were people in Congress who screamed that this would be impossible to do. You couldn't possibly have the same accounting standards for every company, irrespective of size and sector. And if you could, then it would spell the end of American capitalism. Now we're seeing the same thing now, except the lack of transparency is on the impacts of companies. It took 4 years after 29 for legislation to introduce in the United States GAAP accounting and auditors. It's taken 2 years after the crash of COVID-19 to see the establishment of the International Sustainability Standards Board and the announcement by the SEC about full transparency on environmental impacts. And this data can be proved to be price sensitive, stock price sensitive. You look at the Harvard Impact Weighted Accounts Initiative, and you will see a correlation between higher levels of pollution and lower stock market valuation in many sectors. And so regulators have to act, because if this is stock price sensitive data, then everyone has to get it at the same time, on the same basis, and the data needs to be verified. And that's why you're beginning to see regulators move in the way that I have described. And so I think it's inevitable now, Harlin, that we're heading to impact accounting, that within 3 years we will have the mandatory publication of impact statements, which will give investors the information they need. And as you were correctly saying, if that information only measures the impact on the company's profits today, it's missing the point. The valuation of companies on the exchanges of the world is being affected by the broader impacts they're creating, even if they're not affecting their profitability today, right? So this issue of dual materiality versus single materiality is dissipating now. Investors want to have all the information so they can judge what's relevant in making their decisions about the future growth and profitability of companies.
Yeah, absolutely. And then just to kind of go, circle back a little bit on some of your earlier comments on social impact bonds and governments, right? Putting a price on conservation and putting a price on social impact, and paying investors for that. One thing that has been coming up over the last several years is the decline in the population of bees. And if those of you have heard me speak about this before, it's actually pretty amazing that pollinators contribute or are responsible for about $600 billion worth of food production globally. It's an incredible number, and they're not paid for their contribution to food production. But a decline in the population of pollinators is a significant threat to overall food security. And so some of these structures in conservation and being able to value the contribution of nature as well to society is going to be a pretty big game changer. And I mean, most of social impact bonds have been done, as private placements and kind of on the side, they're smaller issuances, but we're starting to see that change. And we just, worked with the World Bank on one in South Africa, a conservation bond that was essentially a pay for success structure that enables then a nonprofit, a conservation agency, to really be able to free up capital to do even more work and take some of that risk off of their books to start with, which is an incredible way for investors to participate in very specific impact areas as well.
Totally. I mean, I continue to invest in early stage impact ventures, and I see so many ventures now about the measurement of different impacts, social and environmental, and different agricultural impacts, and so on. There's an explosion now, particularly as the technology makes it so much easier to deliver. The ability to use satellite data and compare that with artificial intelligence enables us to measure a lot of these impacts and put an economic value on them in ways we wouldn't have been able to do even 5 years ago.
So I was at a session yesterday and we were talking about the US municipal bond market and how, many investors use muni bonds as a way to achieve impact, right? Because municipalities are generally spending on infrastructure and the like. And there was a lot of debate on financial materiality and risk. So climate-related weather risks on municipalities' ability to pay back their bonds versus impact. And it was interesting because there was a debate on whether the two should be treated separately or whether they should be treated together. You know, my view is that for a municipality that is actually, you know, raising capital to improve their climate resiliency, for example, that should overall improve their credit worthiness over time. And so you can't really take the two apart either. So, you know, some of what you're talking about in terms of you have to evaluate the impact in order to evaluate whether or not an investment is a sound investment, you know, makes a lot of sense. And I think that's starting to make its way through the investment community. Of course, starting with clients or investors who have been in this space for a longer period of time and can kind of see that a little bit better. But you know, we still have a lot of investors who are not entirely convinced. So you touched on it a little bit before, but would be curious to hear your views on returns, and not just in public markets, but also in private markets where we have companies and ventures who are creating new technologies, who are creating new solutions to the climate problem, to social inequities, et cetera. What do you say about that?
I say that if you think about it, if you're polluting, for example, or if you're creating social issues too, the risk of regulation and taxation is a lot greater than it used to be. So we're already talking about a carbon tax, Harlin, right? Why? Because we have transparency on carbon emissions, and governments can begin to be fairer about who they tax. They don't need to tax everybody in the same way, irrespective of the damage they cause. And if you think about it, this risk of regulation and taxation is going to impair very significantly the growth and the profitability of companies that do harm. At the same time, the companies that are putting impact at the core of their business models are taking advantage of the greater appetite of consumers, of talent, and of investors for investments that do good and do well at the same time. And it reflects itself in the ETFs. You look at the ETF for clean energy versus fossil fuels, they go in opposite ways. So you can already see it happening. And when you begin to think in terms of impact, you open the door to sets of opportunities you would never have considered before. In my book, Impact, I refer to an Israeli tech company that launched an impact venture designed to help the blind, a company called Orcam. It invented a pair of spectacles with a little device hanging off the arm of the spectacles that whispers into the ear of the wearer the page of the book they're reading, recognizes 300 faces, transforms the lives of a blind person. Now, it's a fantastic venture. 35 million blind people in the world, 250 million visually impaired people, has huge potential for growth creation and value creation. But if you think as an impact entrepreneur, you ask yourself the question, how could my product improve the lives of the greatest number of people on the planet? And it opens the door to opportunities you'd never have thought of. What if we provided these spectacles to the 800 million illiterate adults in the world? What would that do for their lives, their livelihoods, for their economies, for the world economy, to bring 800 million people from complete illiteracy to being able, inverted commas, to read? Unbelievable. And so all of a sudden, you've defined a market that's more than 3 times the size of the one that was visible to the eye. So impact companies are going to apply their skills to satisfying massive latent demand, often at lower price points. So I believe as an investor, I've spent the whole of my life in the venture capital and private equity field, at least until the age of 60, and then in impact investment. I firmly believe that this is just a better way to deliver higher investment returns, that this shifts us to a higher efficient investment frontier. And optimizing risk, return, and impact is the way to benefit from greater growth and, in my view, greater profits.
Thank you so much, Ronnie, for joining me here today. It's always wonderful to hear from you and get your insights. Appreciate your time, and have a great rest of your day.
Thank you very much, Harlin. Appreciate the opportunity to chat with you.